Good morning, good afternoon, good evening, wherever you are. I say that deliberately because this is a global symposium, and at any one time we've had up to 1,000 people online participating, ranging from breakfast in California to nightcaps in Tokyo. So wherever you are, welcome. If you have been with us from the beginning, you'll have known that yesterday we did a very deep dive on central bank digital currency, CBDC, particularly looking at retail applications and retail launches in places as diverse as China, the Bahamas, and Haiti. This morning we started to move on to looking at the applications of CBDC potentially in wholesale markets, and then we've spent a lot of time talking about capital markets and digitization, particularly of financial instruments. We're now moving on to a session to look at digitization, particularly of non-financial instruments, but the whole capital markets infrastructure and the potential for tokenization, disintermediation, and so forth. You will see in the chat box on your screen and to the right-hand side of your screen a function for both conversing amongst yourselves, arguing with the panel, and putting questions to the panel, which will be moderated through our team. So please feel free to do that and to talk amongst yourselves and with us. We've had this morning some very major arguments, a proposition on the one hand that the current structure of financial markets, capital markets trading, and indeed trading of other assets is very ill-suited to the digital economy, not least due to the expense of trading and the delay between purchase and settlement, and that actually the digital economy requires something far smarter and far faster, and that will be provided by tokenization and distributed ledger technology of one kind or another. There's another proposition that says actually no, capital markets work quite well with trusted counterparties, trusted intermediaries, and guarantees of settlement and liquidity, and actually very little needs changing. We've had also a lot of debate about, can you have a wholesale instrument backed by fiat currency without an equivalent retail digital instrument? So an awful lot to talk about, and I'm delighted to welcome four real experts in the field. Jennifer Peve, who is Managing Director for Business Innovation at DTCC, Depository Trust Clearing Corporation in America. Mo Pham, who is a Senior Advisor on FinTech at the Bermuda Monetary Authority, and by the way, he's got a virtual screen on. He's actually sitting on a beach in his swimming trunks today. We envy him enormously. We have Steve Kokinas, who's the CEO of Algorand, sitting happily in Boston. And we have Dmitry Tokarev, who's the CEO of digital infrastructure platform Copper, who's with me in freezing London, where the sun is desperately trying to shine. So to shine some real sunshine on it, I'm going to pass the baton to Jennifer Peve at DTCC to get us going. Jennifer, over to you, please.
Thank you very much. So just to give a little bit of background, my team plays a key role in shaping our organization strategy through three main functions: corporate development, global partners, and innovation strategy and design. And so today it's that team and that function that I'm going to focus on. And within that lens, we are continuously and ongoing, looking for and identifying business opportunities, potential acquisitions, partnerships to broaden and deepen our capabilities, as well as looking for ways to explore and experiment with some of these newer, unproven or newer, recently proven technologies, just helping to advance that dialogue on digitalization, and then also developing thought leadership for DTCC in the industry. So the way that we tend to approach this these new and novel concepts is through four key areas, right? Ideation and design, discovery and demonstrate, thought leadership, and then industry engagement. DTCC has played a pivotal role in protecting and supporting the growth of the global financial markets for several decades, and so we have a lot of experience tackling some of the industry's biggest operational challenges, while also processing, millions and millions of securities and other instruments every day. So for me to be able to think about how these new and novel concepts like digitalization, tokenization, blockchain, and other emerging technologies, how those are going to actually shape our future is pretty exciting, and it's actually pretty, a big honor for me to do that. DTCC has been closely evaluating and engaging around blockchain and tokenization for several years now. Originally, I think our goal was to beat the horse and understand, continuously understand and watch its maturity. Kind of develop some foresight around the potential time frame for mass market adoption, as well as its potential applicability. I think over time, we've definitely, as many others in our industry, have come to the conclusion that the technology has several purposes, right, and can certainly drive some efficiency in the capital markets ecosystem. I think originally looking at blockchain as an underlying technology or infrastructure play, I think was much more difficult for the industry to get around. When we shifted to now thinking more about how to maximize the value of the technology by enabling digital assets around real tradable assets, that to me is when it really opened up a lot more opportunities. And I say that because as an infrastructure play, the blockchain and DLT can be certainly valuable, but so very difficult to change an ecosystem where you have very critical market infrastructure, heavily integrated and interconnected pipes between multiple stakeholders across the ecosystem. That becomes a really big ask to just kind of rip something out and put something new in. That being said, there are many opportunities you can take to think about spaces where you can leverage the technology to bridge legacy and new assets. So to me, this is one of the areas that I think is really interesting and I see more and more financial institutions and market infrastructures exploring opportunities in that realm, because if you focus on more of these greenfield or white spaces, introduce the technology in a meaningful way, you build operational confidence around it, you demonstrate value to your clients, and then hopefully that's a way to start to move the industry over to something new. I think blockchain, as with any technology, definitely has to be thoroughly vetted and tested for your use case. I by no means mean that there are still challenges with the technology. I think the biggest challenge we have with the technology is operational confidence at this stage, right? And so developing that operational confidence, I think, is critical. I think any modernized solution needs to be robust and as robust or more and resilient than existing applications. Speaking as a regulated entity, that becomes very important when you're thinking about how our financial markets depend upon the assets that we trade and that we process today. I think adoption of these newer technologies and new business models, they do take time. So whenever I hear someone say, "Oh, this has taken so many years and nobody's really done anything," I disagree, right? I bet every single one of the panelists today will tell you exactly how they're approaching this market and what they're doing to solve for some of our challenges. And there are new business models that are coming up. I see fintechs come to us and demonstrate new applications and new ways to solve all of those challenges that you hear people talking about when the adoption of newer technology comes up. So I'm pretty excited about what the future holds here. I do believe that there's a role for centralized parties in some way, shape, or form. Their business models may also change, and I think if you accept that and think about how to now create new opportunities for you to serve your clients, bridging legacy and new during those incremental phases of helping to shift the industry from legacy technology to newer technology, as well as other opportunities. I think then you've got, there's some really interesting future outcomes that we could see.
Thank you. Do you see at the moment that the thrust is towards improving existing markets in existing assets, or to creating a whole new ecosystem and a whole new set of assets, i.e. digital assets, which previously haven't existed in physical or paper form?
I'd say there's three things to me that are happening, right? You've got one set where people have been focused on looking at the technology and the opportunities around existing processes and how do we just fix what we have today. I feel like that's a really difficult proposition right out of the gate. Then you've got, then you have certain use cases and business models that have been created to introduce what I'll call bolt-on opportunities. So things that can introduce new ways of working, things that we just don't do today, but because this technology can enable a better way of working, more efficient distribution of data, synchronization, and capturing the assets and everything that goes with them in a much more streamlined manner, these bolt-on opportunities become really interesting, right? So, collateral, digitalizing collateral and what HQLAX has done, I think is what I would consider like a bolt-on, right? We still have to do the collateral processing that each of our institutions do today, but this is helping to bridge and kind of share the collateral or lend it out in a different way, right? And I think that's pretty interesting. And then you have the full new opportunities. I will say, as a bolt-on, our Project Ion, which was focused on working with the industry around using this technology, tokenized cash, tokenized securities, re-representing existing shares on blockchain for accelerated settlement, that was also something I would consider a bolt-on, right? How do you introduce a new settlement service that accelerates the time to settlement and do it in a better, more efficient manner? And then, the third thing is really looking at those new white space opportunities, right? So targeting areas that just don't have a lot of infrastructure today, are highly manual for whatever reason, or have very fragmented technology solutions, and thinking about ways to bring those stakeholders together in a platform to create network effects and a true ecosystem where you continue to expand the value of that platform. And a really good example that we've been working on in that space is our Project Whitney, which is focused on private markets and looking at a new way to introduce this technology and the tokenization of assets to help solve for some of the pain points in the private market space.
Thank you. I'm going to turn on to now. I've read it. Bermuda is famous for thinking up new asset classes, looking at different ways to regulate and register companies and asset markets of one sort or another. So I'd be interested to hear your thinking on this from the perspective of a semi-sovereign state that's looking, I think, to create new markets rather than simply retread old ones. Over to you.
Thanks, Philip. So yeah, Bermuda has got on one side beautiful beaches, but it also has a very vibrant financial sector led mainly by insurance companies, one of the largest financial centers, insurance centers in the world. And back in 2018, there was some discussion on how we could, bring this thinking of innovation, having pragmatic regulation to digital asset space, and taking the lessons of how we developed the insurance market. We drafted a Digital Asset Business Act, which came into law in 2018. And one of the main difference from the Digital Asset Business Act is in its definition. Instead of trying to have narrow categories of instruments, it looks at the digital asset in a very broad manner, such that entities can have legal certainty, and we spend less time thinking about well, is this a digital asset? And if it is, then what bucket does it fall into? And is that bucket evolving over time? Is it an hybrid bucket? And all of these very difficult questions that, um, to be honest, if we were still, thinking about them, we'd probably not have a legislation passed 3 years later. So we looked at the definition very broadly. We have a broad definition of digital assets. So when you do that, what you need to be doing is you need to keep principles-based regulation so that you have the ability and the flexibility to then adapt to the various products. So what we do is we really look at what is the infrastructure, how should we regulate that as a first step, and then look at what products are going to be distributed on that infrastructure as a second step. And really taking these steps in sequence, like it seems like very like marginal, but it is very important. When you start with the product first, it introduces a lot of complexities in this space. So I think this aligns well with how companies, and Dmitry and Steve can definitely talk about that, how companies think about how they develop their infrastructures. Companies now are interested more in building platforms, and instead of offering products itself. So I think there was a good alignment in between the way that we designed this and the way that the industry is developing. One other area that the Digital Asset Business Act brings is when we think about these infrastructure, usually they don't live in silo, right? They live in a value chain. And when you think about a financial transaction or a digital asset transaction, there are many different players that are involved, whether it is an exchange, a wallet provider, a custodian, and many more. The issuer itself, if you think just about, stablecoin issuance, if you only merely regulate the issuer but don't regulate the exchanges and the wallets, you introduce a lot of vulnerabilities in the value chain, and the customer does not end up necessarily in a better space. So the Digital Asset Business Act gives us the ability to regulate the entire value chain. So I think, when we think about, how we approach this problem, these would be the main, I guess, defining factors of our legislation.
Thank you. There is an argument that I've heard quite a lot recently, which says, look, one of the benefits of decentralized finance supported by a decentralized non-intermediary based blockchain is that you democratize finance. You cut out the intermediation, you cut out the exchanges, you cut out the oversight, which then begs the question, well, do you need a regulator in that system at all?
Yeah, I think you still need a regulator in that system, but the role of the regulator will definitely change. Just like the approach that we've taken, I think we could take it a step further, and instead of looking at kind of the governance process, with kind of how the board delegates its function to senior management, and what is kind of the risk management function and reporting in the organization. We could look at how this is designed in in a decentralized manner or automated fashion. Of course, this is not something that will be done overnight. But it is something that we are currently considering is, what is the role that a regulator could play in a decentralized finance protocol. And I said that, we took a very broad definition of digital asset in our legislation. I think in the decentralized finance space, I think the usage of decentralized is used very broadly, maybe too broadly sometimes. And I have a feeling that some of these protocols are not as decentralized when you look at it. deeply as some would think. So there's also intricacies related to that we are currently considering. But if we take the view that we would have a protocol that is inherently decentralized, then I think we could consider how the governance could be embedded into the code, and what the regulator could do about this. Maybe the regulator becomes a sort of oracle in the future.
Not least because digital actors are of necessity going to be physically based somewhere, which means that at the very least an entity can be physically supervised and regulated, one supposes, by whichever regulator happens to master that jurisdiction. Before we move on, I just need to like to prompt the audience participants. We have a couple of polls running at the moment, which would encourage you to vote on and get involved in, depending on how you think this conversation is going. The first poll at the moment is asks, the benefits generated by the tokenization of capital markets will outweigh the risks of transition. At the moment, 3/4 of respondents think that that's largely true, and 1/4 of them think that it isn't. And the second poll is asking that in capital and wholesale markets, who will benefit most from tokenization? And at the moment, we are roughly split between the buy side and exchanges, which seems to be slightly paradoxical, but anyway, onwards with that. But do please fill that in, and we'll keep you updated as we go along. Now it gives me great pleasure to pass the word over to Steve Kokinas, the CEO of Algorand, who has indeed spoken an awful lot and very perceptively about the democratization of asset trading, and has some very interesting use cases around NFTs and others. So, Steve, over to you.
Yeah, thanks for having me, Philip. And just to give everyone a brief intro, Algorand is a new foundational public blockchain that was created by Silvio Micali. Silvio is really one of the founders of modern cryptography and a longtime MIT professor and winner of the Turing Prize. And I think if you take a step back on all the discussions that we've been having today, we really see what's happening in sort of the blockchain and crypto world as sort of the formation of the Internet of Money. And we think as part of that, you require a foundational technology that's scalable, secure, decentralized, and energy efficient. And I think what we've spent a lot of time thinking about is not only how people will start to be inventive with tokenization, but also how do you enable people to very simply create both new kinds of assets and new forms of revenue flows around them, but in addition, new business models entirely. And I think what we've been seeing happening out in the space is really fascinating. And I thought I would just walk through a few different examples, since I think at least nominally the subject here is for tokenization beyond currency. I think what we've been seeing is a lot of innovation in a few different areas. One is sort of marketplaces. The second is around NFTs, but also really tokenizing and creating revenue rights around different forms of more traditional rights, such as things like music. Also seeing inventive ways for people to tokenize things like home equity and end up with better outcomes for people on both sides of it. And then I'd say sort of in response to all of those, we're seeing security token exchanges in different parts of the world that I think do address some of the regulatory concerns as these new forms of assets show up. And just to give a little bit more of a concrete sense, I think on the NFT side, that's obviously something that I think has sort of captured people's imagination, at least in the general public, in a way that we probably haven't really seen since the early days of the web. And at the same time, I think that what excites us is sort of this transition of traditional business models into digital ones. And a few weeks ago, CI, which is the Italian music rights system, actually deployed about 4.5 million NFTs onto Algorand that represent the music rights for over 100,000 artists in their system. And I think that that's a really significant shift for them. That's a 139-year-old business that's sponsored by the federal government there. And it's I think it's a sign not only of the need to shift, but also the needs of artists. I think if you step back in that world, the largest artists have no problems selling music rights, having different forms of revenue, but so there's sort of a big middle class there that might have hundreds of thousands, not millions of dollars worth of music. And what we're seeing now that they've brought that on chain is royalties can be paid on chain. There's more transparency around how royalties are being paid. If songs are sampled and now you have multiple writers that are part of different songs, it's very straightforward ways of tracking who's do what. And beyond that, we're now seeing new applications. One is called Opulus, and that's a decentralized finance solution for artists, allowing things like borrowing, lending, selling of music rights, and new revenue streams around them. So I think that's one really interesting example. We're also seeing that, kind of bridge out into other places. I mentioned energy efficiency. Climate is something really important to us. So Planet Watch is another non-currency example. They're backed by CERN, and what they're doing is tracking air quality around the world. And they use sensors that people either carry around with them or installed around cities. And one of the things that cities are sort of hesitant to do, not that anyone would report incorrect information, but not everyone is that excited about paying carbon credits based on the air quality. And so this is a way of actually immutably proving what the air quality was at different points in cities around the world, and then can compare that to what the cities are reporting themselves. And and then on sort of the home side, I think home equity and sort of tokenizing more traditional assets is something that we've seen a lot of excitement around. We're seeing people like Vesta Equity creating a peer-to-peer marketplace, connecting homeowners and people who are looking at investing in properties in smaller amounts together, which ends up with better outcomes for both sides. There's lack of a need for a traditional bank for people looking to sell some of their home, and then there's an opportunity for people who have lower denomination investments to come in and participate in that. And as these sort of novel applications start to form up, I think what's also interesting is we're seeing new forms of security token exchanges and alternative trading systems cropping up. Archax is FCA regulated in the UK. We just announced Symmetria this week also, which is regulated in Israel. And I think we'll start to see more and more of that, where there are companies that are really focused on kind of bringing new forms of assets and new business models into the market. And then there's also new platforms and trading systems that are regulated and I think really provide the protection for end users that's needed in the market. So I think it really is a fascinating time out there.
I mean, it's not only fascinating, it's very exciting, but talk me through. I've just written a brilliant song or a symphony in Italian. So talk me through, how does this actually work?
Yeah, sure. So, there's sort of two forms of music rights in the world. Most places it's tied to their country. In the US largely, but there's a few other examples. Music rights are tied to private companies that help them. And effectively, you write a new song, you're copywriting it, you publish it into the system that you work with. They then are responsible for tracking, or working with places like Spotify, but also radio stations and any form of kind of media, and making sure that the artists are paid their rights, and effectively acts as a collective, so that no one artist is sort of left behind there. And by having more force, they can make sure that there's no bad actors in the system. And but yes, I mean, I think for the artist, at least initially, it won't be that different. They'll still publish their rights into CI, what will change is that instead of CI, writing it down in a book or in an internal database, they publish it onto the blockchain, and now everyone can see what those rights are. Everyone can see what music rights a given artist has, and then new applications can form around it. I think the other part that is really useful there is I think one. Artists want to be able to monetize their assets more effectively and have their fans be able to participate in ownership of some of that, or participate in the revenue streams they're creating. The second is there's a lot of confusion in the market around how people are getting paid and where their sources of revenue are. And for instance, how many track listens there are on Spotify or on Apple Music or others. And so now by publishing all that data onto the blockchain, it becomes much more transparent. And for an organization, like CI, it dramatically streamlines a lot of the discussion points around, whether people are actually receiving the right kind of economic benefit that they expected to or should be getting based on what's going on. So it really adds transparency across the board and ultimately opens up the market to a much broader range of artists versus what's typically favored, the most popular artists.
We're clearly stimulating a torrent of questions here, Steve. I've got one here for you from Richard Jordan, who's the former director of UN operations at the Royal Academy of Science. And he's noting Trevor Lawrence, a college football player, has just signed a contract to be paid a signing bonus in multiple crypto coins. Do you see athletes, other personalities becoming brand ambassadors for various types of coins? How does that fit in with the whole business of NFTs and tokenized asset?
Well, I think I'm not sure. I think certainly there'll be brand ambassadors. I think in many cases there'll be brand ambassadors for themselves and for their teams. I think one of the things that NFTs are uniquely positioned for is I think that people that have the ability to drive their own marketing and publicity, they can kind of optimize the value of their brand. And so I think we'll start to see certainly more people being paid in cryptocurrency, and we hope that trend continues. But at the same time, I think really rather than athletes and artists getting involved necessarily being brand ambassadors for cryptocurrencies, I think they have an opportunity to individually monetize, sort of the brand assets they've created themselves, rather than always sort of having to go through a league or other people. So I do think it's a liberating experience for them as well.
I will just jump in real quick if you don't mind. Over the holidays, I was, at various, grocery stores or hardware stores. Those are the only two places I went for various reasons. And it's really interesting that the power, if you will, that, these individuals have, right? Because, especially in the States or in any sport, any country, you've got your own popularized, athletes, et cetera. And when they're out there talking about things like cryptocurrencies and their contracts and creating NFTs, it actually just brings that conversation down to the average retail investor or person, right? So you're walking through a store and I hear someone talking about NFTs, and I'm like, whoa, like it's actually reaching, from a discussion standpoint, at least mainstream. And so then you just have to wonder and watch, how does that momentum potentially add to these new business models that are coming out and really get people interested in exploring and researching and adopting some of these newer opportunities. So I think it's going to be interesting to see how that all kind of comes full circle.
Yes.
Yeah, I think oh, sorry, Philip. Just one thing to add on that. I completely agree, Jennifer. And I think one thing that's probably useful for everyone to think about is, at some point here, there's going to be more NFTs that people want to create than there are people who want to buy them, which I think is sometimes a byproduct of exuberance of a new technology. And I think we saw this in the early days of the web also, right? I think there were a lot of people that didn't really need websites that thought they were going to make a lot of money from them. I think certainly there's incredible innovation and invention going on. I think one of the things that we think are fascinating, just to go back to the music example for a minute, is that that's a form of NFT that meets the needs of sort of all sides of a transaction, but also has definable income streams. So every single song in someone's catalog is generating revenue, and by virtue of that revenue, there are ways to straightforward ways to determine what that asset might be worth. And we think over the long run, there's going to be more of that happening, and people are going to use these constructs for new things. But that's a multi-billion-dollar a year market that's moving on chain and doing it very quickly, because the way they've been transacting simply doesn't work. On the flip side, though, I think it certainly doesn't hurt that this seems to be capturing people's imagination, and I think that's a good sign for the market as a whole.
Of course, the securitization of music rights is not exactly new. I mean, David Bowie did it 20 years ago. So, and I have to say, if celebrity endorsements of champagne brands are anything to go by, I'm going to steer very, very clear of their endorsements of NFTs. Our third speaker has been sitting very quietly and patiently, and I thank him for that, because I know he's a real revolutionary around some of this stuff. So let me pass the microphone immediately to Dmitry Tokarev, who is CEO of Copper. Copper is a digital infrastructure provider, safe architecture provider, and he'll tell you more. But over to you, Dmitry.
Thank you, Philip. Can you hear me okay, by the way? Yeah, excellent. Excellent. Sorry, my camera died. I had like 5th call in a row, so my main camera died, so I had to switch. Yeah, so on the Copper side, we provide safeguarding and trading infrastructure for fund trading firms like market makers, HFT houses, all sorts of different prop shops, consumer platforms like neobanks, payment processors, financial institutions, and I'll touch on that later because that's sort of in line with what we're discussing today, as well as foundations and treasuries. I mean, you guys covered a lot in 37 minutes, and obviously, I disagree with some of that. With some of that, I disagree, vehemently. With regards to traditional market infrastructure, on my side, that's what I've seen in my career. So I've been sitting in back office, middle office, basically chasing settlements, and 70% of our budget of a firm went into chasing settlements. So if somebody mistypes ISIN or mistypes a comma in MT500 message on Swift, you basically end up with a custodian, sub-custodian, and a sub-custodian running around, not for 2 days. T+2, it's if you're lucky, right? Like I've seen T+30, I've seen things not settling, all sorts of things, essentially. And then the challenge becomes is you need actually people involved physically. You need to wait until the Geneva guy is going to come back from lunch, and New York guy is going to come into work and not going to go into the meeting. So you need to catch everybody together, recall the messages, and do it again. So in terms of robustness of the infrastructure, very much would question, at least that was my experience in terms of the traditional infrastructure and how robust it is. But again, we're an infrastructure provider. We're working with financial institutions today who are very much the tone has changed in the last year, and I think due to the fact that the migration takes ages, and the entire system creation and implementation also takes 12, 24, 36 months to implement. The general kind of theme that we're feeling right now in the market is that they don't want to miss out, because they know that essentially if there is someone else across the road who does provide services with usage of blockchain and is able to provide buy-side players to move us. And again, like we're talking about NFTs, and we're talking about certain other different. And this is great. It's amazing how the technology can be used in a variety of ways. But what we're talking about here is hundreds of billions of total addressable assets, trillions of dollars cleared today, quadrillions of dollars cleared annually. And it's such a humongous market which functions to my surprise was when I was, starting my career in financial services that way. And, with blockchain, it became clear, to me that ultimately we will see changes. And the two kind of parties which we see a lot, like realizing that a lot and almost in the race would be, financial institutions, because they don't want to have legacy infrastructure when, a nearest competitor has a better product. And this is something which you cannot react to. Like this is quite important, because let's wait and see how this plays out is incorrect strategy. Because when that plays out, when somebody launches, fixed income instruments on Algorand and starts, providing buy-side players with a service, you can settle it, in several seconds, 24/7, 365, trade it 24/7, 365, do yield farming on that 24/7, 365. That's going to be a little too late to kind of go like, okay, we're going to build the same in 3 years, right? So this is one thing. Another thing on the governmental levels, what we're seeing is that, and I can't really name governments, is that this is an interesting piece of business to bring into the country, because we're talking about broader financial services. We're talking about either domestic companies, creating a new structure in where they can basically get bigger market share, that therefore bringing more jobs and more GDP into the economy, as well as new projects essentially. And at the same time, the instruments that we're talking about here that people are building using our infrastructure, they could be utilized as well as geopolitical tools. And on that front, you most certainly want to be careful, like who's got what. And there is a lot of, just want to be careful what I say, given the fact that, how many people are listening to this. It's like there's a little bit of a race or kind of like on financial services going on, like where the next center is going to be and how this is going to play out. And everybody wants to bring that towards them rather than leave it where it is today or leave it to a competitor. With regards to DeFi, again, this is DeFi or general blockchain. Again, we worked with systems before, with MiFID II reporting, whereas today, after each trade, you have to report like 84 or something fields to an unauthorized institution, which then going to be processed, once a month by the regulator to see whether there is something suspicious going on in those activities. I mean, blockchain is a blessing in disguise for any regulator if private sector implements it correctly, because you can literally, with specific permissions, to see everything that you want. And the role of the regulator, to echoing what Maud said, could change to more of tech play rather than humans moving stacks of paper or trying to find things retroactively. You can actually implement tools. You can basically start searching for patterns, and you can actually trace everything back to its origin. Whereas in traditional plays that wouldn't be possible. So those are the kind of things that we're seeing. And in terms of tokenization of traditional assets. I mean, from our side, from Copper's standpoint, we service 300 plus clients, got 100 plus employees in 6 locations. But at the same time, there are, we realize that this is something which we can't do on our own. There will be there needs to be a broader market interest, and it started happening like literally in January. In January, we started seeing players coming into us with a lot of money, a lot of billions under custody, etc. So like, look, we need to build this because we don't want anybody else to build it first. Like, what do we do? How do we do it? Let's start with Bitcoin, and but this is a testing ground. So. That's, and who benefits from the tokenization? I think the most popular answer should be the consumer. Because there is a variety of way how the consumer is not seeing basically fair treatment in the market today, and there are numerous examples. Like exchanges are fine. They're printing money today, etc. But the consumer will see the most of the benefits because the products are going to be competing for delivering the cheapest and product to them. Companies are going to be competing in delivering the cheapest product to them and the most competitive product to them. And even if you look today, what's happening in crypto is no one talking about like rehypothecating assets and not giving you any interest on that. So that's something which doesn't exist. 80% of interest is paid back to a consumer. If you look at like how Prime functions in a crypto space, there are cases here and there, but then ultimately that those money will channel somewhere where consumer will benefit from having assets with a provider that actually generates them yield on those assets and doesn't charge them on having those assets with them. And last but not least, we touched upon like people choose to get paid in crypto. I mean, there is something maybe to do with the fact that it's a totally different discussion, but I thought it's just worth bringing up because I don't have an answer to that. But the fact that 35% of all the dollars been printed in the last year maybe has something to do with that. So, and I would be very keen to kind of like listen to some other panels with regards to where we're heading and with regards to just general fiat currencies and how this play is going to end. But there are factors which are beyond like I want to create a hype on Twitter and get paid in CryptoKitties, and create myself like a higher profile so that Kardashian retweet myself in there, I believe. So that's just couple 2 cents from me, but happy to answer any questions you guys have, on sort of clients, etc. Like this is we're more in the trenches on the battlefields with the buy side clients in the crypto space today. So whilst creating the infrastructure for traditional FIs.
Thank you, Dmitry. That was $5 worth rather than 2 cents. Interestingly, that the largest number of individuals by nationality holding Bitcoin at the moment are Nigerians. And that is not because they're speculators. It is research suggests that they think it's a more valuable location for their savings than the sovereign currency in Nigeria. So and that promotes a thought to me that just to put to you all about who is the consumer here? Is it the man and the woman in Jennifer's supermarket who probably do need a lot of regulatory protection, or is it the current big institutional players who probably can look after themselves? Discuss, Jennifer.
Well, I think that's a little bit complicated. I would still go with it's ultimately the end user, right? So the people, your Main Street investors, if you will, everything that happens in between that, right, is about protecting them and their assets and ensuring that our financial markets are sound. But it does start at financial institutions and kind of changing the way that they do things and offering things in a new way. So I do agree with Dmitry that I won't call it fear of missing out, but I do think there's a realization across the industry where many firms are now looking at what's happening on the crypto space, NFTs, the digital asset space, and just their legacy businesses. And there's a recognition that the time is coming where these things are going to all converge, right? And so how do we start to be thinking about addressing that? And I think a lot of firms are thinking about what's their business model in that scenario, right? Are they going to be completely disrupted, or most of them don't want to be, right? So they're being just as creative in thinking about how they set themselves up for their future. All the while, everything that they're doing is about protecting and ensuring that the Main Street investor has greater access to new and different products and assets to trade and invest in, et cetera. But it does start, in my opinion, it does start at the top.
Steve, when we see 5,000 Instagram pictures being sold for $65 million or whatever else, is this a black tulip moment, or is it a sign that the consumer can approach NFTs with a good deal of confidence?
Well, I think first of all, I think the answer is to who is going to use digital assets and digital technologies. I mean, the answer is everybody. And I think if you look at what's starting, the early days of the internet, people are like, oh, what are we going to use the internet for? Why would we shop on the internet? Oh my gosh, we'll never watch TV there. There's no bandwidth. So I think where we are is really as the starting line. And I think companies like Algorand or companies like Copper are building the infrastructure that people need to kind of reformulate these things in new ways. And I think what was harder to really contextualize in the early days of the last wave was, Netflix or Facebook or Twitter or other things that have, kind of changed the way people communicate. And I really think what we're doing here is finding new ways for people to communicate value, and that really includes everyone. So I think that, the answer is so the answer to your NFT question is, I think, a little bit subtler, which is one, I think that, the headline is there was 5,000, images. I think the work that People is doing and many other digital artists are doing is fascinating. And there's, depth to that work, just like there's depth to fine art in the traditional painting world. I mean, these are new forms of mediums that people are finding ways to use and display. And I think more than that, you have a generation of young people that have grown up playing games and acquiring unique avatars and other things. My kids spend time playing gaming online and spending money in virtual worlds. And I think these are completely normal constructs for them and for a whole generation that largely people who missed out on that don't understand. And so I think these are kind of very natural developments. And I think they're the first green shoots of truly innovative art and business and other models. And I think we're going to see a lot more of it. Now, I think in terms of what people should pay, I mean, buyer beware also always, and we'll see where these markets play out. But I think certainly there's enduring value being created here and new business models. And I think NFTs are sort of one of the first ways to express that that have really captured people's imagination. And I think the work that digital artists are doing and the fact that people are paying, ever increasing sums for it, it does certainly help generate, increased interest. So I think there's a cycle going on right now. And I think, but really, we're really at the very beginning of it. We're at the start line, not the finish line for all of it.
Okay, but your underlying message there is caveat emptor, rather than that the authorities have the obligation.
Yeah, well, my message is two things: that we're at the beginning, and that I wouldn't be dismissive of some of these new business models and forms of art and things that I think will likely be part of, pop culture and culture in general going forward. I also think, though, it's a, sort of prudent advice to anybody to, don't just buy stuff because you think that it's going to go up in value. I think that's true in the traditional art world. You should, people buy paintings and other art because they like it, and it's worth it for them to pay. I think the idea that you're buying it just because you think the price would go up, I would, caution anyone against that. But I do think that there's really innovative work going on.
Well, there is the proxy owner of several magic swords, invisible cloaks, and spells pots or whatever. I know exactly what you mean. Brad, I've a whole range of questions coming in, which may be or may not be pertinent to you, which is around tax. Robert Hertzky, professor at Nicholas Copernicus University, Kristen Williams, chairman of RT, asking questions about, do digital financial solutions, digital assets deserve fresh taxation rules? How does this play, given some of the OECD views around taxation? Do you have a view on that?
I don't specifically have a view on that. I think this relates more to individual policymakers that are responsible for taxation. However, there is inherent complexities related to this question of definition that came in earlier when some of these assets are used as a form of payment and systematically attract requirements for filing information on tax gains and losses, that will inevitably slow the adoption of these digital assets as a form of payment. And then there are several other buckets of digital assets that exist that may not necessarily have that issue, but there is definitely some business case to be made in establishing these forms of payments in tax neutral jurisdiction to minimize some of these inherent complexities, but still at the end user level have obligations to pay taxes in their own jurisdictions. But you don't necessarily want to have these complications at the infrastructure level.
Thank you. It's a slightly unfair question for you, but it is clearly a concern amongst policymakers, amongst governments, amongst regulators as well. Final question, really, as we're coming into the last 5 minutes here for each of you, quickly. How do we expect, or how would you expect the capital markets to look different? In what major elements in 2 or 3 years' time as a result of digitization of assets? What's going to be fundamentally different? Dmitry, can I start with you, please?
Sure. I mean, I think in 2-3 years, we will have MVPs probably. I don't think you can expect like something drastically be changed in 2-3 years, because it's just, echoing what Jennifer said before, it's just such a humongous market. Like 2-3 years is not a timeline that this could operate on. 5-10 years for sure. You'll have winners who basically did things right 2020 plus, and then you might see some changes in the market shares, and maybe like on a company's level as well as potentially on the state levels, so governmental levels. So,
Steve.
Well, I think we're starting to see the changes already. Last year, a lot of big banks and others were still, sort of crypto deniers, and now they have trading desks and are putting out memos to their customers to, buy Bitcoin and other stuff. We're seeing large enterprises hold Bitcoin on their balance sheet. And I think you're starting, I think Dmitry is right. I think, we have companies that are starting to form kind of new infrastructure. So I think what's likely in the first couple of years is that we'll start to have more of a blended market where there's, more substantive activity that's going on on public decentralized networks. There'll obviously still, going to be plenty of activity in the traditional markets. And then, I agree with Dmitry 100%, whether it's 4 or 5 years or 10 years out, I guess we'll have to see. My thinking is that it's going to be sooner than later. But I think then we'll start to see who some of the winners are, and also start to see, new business models and, more substantive, dollar volume in decentralized networks than we have today. I think that's where you could start to potentially see a flip between, how much consumer activity is happening in traditional markets versus digital ones. And so, it'll be interesting to see how it plays out. I mean, the timescales are hard to predict, but I think definitely, we're seeing a lot more substance in the market, a lot of new entrants, and much higher dollar volumes at stake than was the case even a year ago, and certainly more than a few years ago. So it's an exciting time for sure.
I agree with you. I think we are going to see development of an awful lot, and whether it's 3 years, 5 years, 10 years, who knows? Now, where do you?
Yeah, I think it's difficult to say, when the new normal will emerge. I do think, however, it's definitely the regulator's role to manage the transition period as best as possible. And the best way to manage that transition is to balance the need of innovators and, the protection of consumers. And I can definitely vouch for the Bermuda experience. Leaving legal uncertainty on the table around how the treatment of these infrastructures and these products is definitely not helping innovation in this space, and does not protect consumers either, because they will indeed seek these products, as can be shown from previous experiences. So definitely I see our role for the future to kind of balance that transition until such time as the new normal will emerge. And then try to get people together to ensure that the future is interoperable and somewhat harmonized.
I think that's sound advice. I think the regulators do have a major role to play here. And you had the first word, Jennifer. You may now have the last.
I'd say, look, over the next 3 years, I think we're going to see a lot more new entrants, new business models that are pushing the envelope on how we do things today, right? Solving for some of these challenges that set us up for using the technology in a much more meaningful way in our future. And so I think monitoring the success of those bolt-ons or those new business models over the next 3 years is really going to help us tell and see what the 5 to 10 year outlook looks like. But I'm pretty optimistic. I think there's a lot of smart people out there, and there's a tremendous amount of enthusiasm about just doing things in a different way to make our lives and opportunities better. So,
well, thank you. If we needed proof of smart people, this panel was it. Thank you very much indeed to all of you for joining us. We have hit our deadline. Thank you very, very much for all your insights and contributions. It's been a fascinating discussion, which we hope will repeat. The final poll results is 90% of our audience think that the benefits of tokenization of capital markets will outweigh the risks of transition. And the beneficiaries are going to be the exchanges, followed by the buy side. So there you go. Thank you very much indeed. I hope you enjoy the rest of the symposium and look forward to talking again soon. Thank you.
Thank you, Philip.
Thank you, Phil.
Thanks, Philip.